Hello CFA candidates. For this segment, my advice is to focus hard initially on these foundation concepts which will pay huge dividends in the future. Here we go. The foundation concepts are the no arbitrage principle. In other words, the idea we're going to use to come up with the price of derivatives should be no arbitrage profit. Arbitrage profit is a risk-free profit and there should be no such profit from combining forward or futures contracts with any other instruments. This approach is built on the law of one price, which states that if two investments have equivalent future cash flows regardless of what will happen in the future, then these two investments should have the same current price. Alternatively, if the law of one price is violated, someone could buy the cheaper asset and sell it at a more expensive price, resulting in a gain at no risk and with no commitment of capital. That's the concept we will use. What we're going to do here is to use the cost of carry model to price a very simple example and demonstrate why it gives us no arbitrage. So here's our model and we're going to introduce a risk-free rate. That's all we need in our initial examples. Here, any risk-free rate we have, we will assume is an effective rate. Specifically, we can take our spot price today, multiply that by the risk-free rate or 1 plus the risk-free rate to the power t to see how long we've got. And that should give us the forward price now. As always with formulas, you need to know how to use them, not how to write them down. To understand what's in here, we're looking at the spot price, we're looking at the risk-free rate. And we're looking at the time until the expiry of the maturity. So there are three elements, but you need to be able to slot numbers into this rather than just talk it through. What are we trying to achieve? But once again, the idea of no arbitrage. We want to make the present value of that forward price identical to the spot price, if you will. Here we consider a 3-month forward on a zero coupon bond. So the 3 months forward of the underlying zero coupon bond currently selling for $100. So, there is the spot risk-free annual rate is 4%. So that 4% is an annual effective rate in this case, and we want to turn that into a 3-month forward contract. Well, if I want to turn that into a 3-month rate, I'm going to have to take it to the power 3 out of 12 months. Had I been told here this was 122-day forward contract, then I'd have used days 122 and 365 as we're effective. But because it told me it was 3 months, I'm going to use 3 months out of 12. What's the forward price? Well, using the formula was just given, we're going to need the spot price of $100 multiplied by 1 plus also 1.04. But I will take that to the power 3 out of 12. That's going to leave me with $101. Any other price will allow an arbitrage opportunity. So, the foundation concepts are not too tricky, but make sure you can interpret them. Now that $101 is the forward price that's quoted today. You will not pay it today. It's a forward contract, that is the price you agree today to pay in 3 months' time. So all you'll do today is sign a piece of paper to commit to buying that bond. If you're long at $101 in 3 months. What if we quoted for this forward price at $105 and that's what you're going to do in the item sets in the exam? Highlight the keywords. The quoted price here is $105. Now in a nice solid question here in level 2, you'd probably have been asked to calculate the no arbitrage price, which was $101. And then they'll tell you somewhere the quoted is $105. Well, your task is to decide how to exploit it. If you see something that's priced too high, it's too expensive, what do you want to do? You want to sell it, so we want to short the forward. So, we use cash and carry arbitrage. What does that mean? Well, we're going to buy the bond in the spot market and then carry it forward and sell that bond in the forward market in 90 days' time. Now we know the spot price is today, it's $100. So we'll get the funds by borrowing those $100 at the risk-free rate of 4% for 90 days. Now we already know by the calculations we've done that that loan would then be worth $101, which we will have to repay in 90 days. Simultaneously, we sell or short the forward at the contractor price of $105. Then we sit back, put our feet up and wait for the 90 days to click past. Once they have, we just watched the free money roll in 90 days' time. We are obliged, a forward contract is a commitment. So we are obliged to sell a bond that we own for $105. So we deliver the bond and we receive $105. Which is nice. However, we do have a liability. We borrowed the $100 at time zero. We need to repay that is now grown to be worth $101. The good news is we are left with $4 that is risk-free profit. Why? Because we weren't left with any exposure. We purchased the bond and simultaneously agreed to sell it 90 days later. So we had the bond that we had agreed to sell. That is, we had zero net position. But we are able to pay off the $101 with proceeds of $105 that gave us $4. So if you look at that calculation, you should be able to see that any price other than $101 gives us an arbitrage gain if we do it correctly, or a loss if we've done it the wrong way round. The only price that gives a zero would be $101, so that's cash and carry. We could also see reverse cash and carry model. So what if the price was too low? Let's say the quoted forward price is $95, which is too low. What do we do? Well, if it's too low and we're looking at the world of arbitrage profits, then we want to buy the forward. And if we are buying the forward, then we are going to short the bond today. That is the reverse cash and carry model. Let's see how that plays out. So it's going to look like this. We short the bond and we receive $100. We invest those proceeds at 4% for 90 days. And guess what? That would grow to be $101. Simultaneously we go long on the forward. We contract to buy the bond for that price that we know is too low of $95. We want to sit back and allow the profits to rolling in 90 days' time. Well, we received $101 from the investment from the proceeds reinvested, but we've agreed to buy the bond that's only going to cost us $95. So we buy the bond for $95 and cover our short. Because we shorted the bond. Well, we now buy it under the forward contract. Our short is covered and we've netted $6 again risk-free profit.